Welcome to the Deep Dive. Today we're taking a close look at Axis Bank. There's some interesting research suggesting it's right at a major, an inflection point.
That's right. It's largely driven by a really significant strategic acquisition they recently completed.
Okay, so the core idea, the thesis here, seems to be that the market is maybe a bit too focused on the short term, like near-term bumps in the road.
Exactly. Things like, the expected cyclical stress in unsecured lending, maybe a one-time provision hitting in Q2 FY26. The argument is the market's missing the bigger picture.
The bigger picture being the long-term earnings power they've potentially built up.
Precisely, the synergistic power. And a huge part of that story is the integration of Citibank's consumer business.
Rat, I saw that mention. It was completed well ahead of schedule, wasn't it?
Yeah, way ahead. And the analysis argues it's fundamentally turbocharged the bank.
Turbocharged how? Like changing their core business.
Essentially, yes. Shifting them from being seen as just a mass affluent lender towards becoming more of a premium retail banking powerhouse. That Citi customer base is quite valuable.
Okay, brings in a different kind of customer. So let's unpack the bull case then. What are the structural advantages they supposedly have?
Well, a big one is their non-interest income, their fee income. It grew 10% year over year recently.
Okay, 10% is solid.
But here's the really interesting part. The quality of that fee income. Apparently, granular fee constituted 91% of overall fees.
Granular meaning less lumpy, more predictable.
Exactly. Less reliant on big one-off deals. And what that means is their P&L, their profit and loss, is actually less sensitive to the ups and downs of interest rates, specifically the net interest margin, or AM, compression that's hitting the whole industry.
So while others might be squeezed by falling margins, Axis has this buffer from fees. That makes sense.
And it ties into their whole One Axis's ecosystem strategy.
Right.
They've got these subsidiaries, Axis Finance, Axis AMC, Securities.
Right, the different arms of the bank.
And the synergy seems to be working. The return on investment in these subsidiaries was apparently huge, something like 49% in the first half of FY26.
Wow, 49%. That's a massive return.
It is. It creates this flywheel, for getting customers, cross-selling other products. It's all part of their GPS framework, growth, profitability, sustainability. That Citi deal fits right into that.
Okay, so the bull case is strong fees, good ecosystem returns, but there's always a but, isn't there? Let's talk about the risks, the bear case.
Definitely non-trivial risks. The biggest one probably centers on that shift towards unsecured asset credit cards, personal loans, which they deliberately leaned into with the Citi deal.
Higher yield, but higher risk, right? Especially now.
Exactly. The timing is tricky, coming at a moment of, emerging challenges in that space.
Right.
There's visible stress.
And the management commentary has shifted a bit. Less optimistic.
Yeah, there's been a noted change in commentary regarding when things might normalize. It suggests, it's a portfolio that needs very careful watching. Active monitoring is key.
And how do they stack up against the competition? They're still number 3, aren't they?
They are the perennial number 3,
Yeah.
structurally behind giants like ICICI Bank and HDFC Bank. And the recent results show that gap.
What did the numbers say?
Well, in Q2 FY26, Axis Bank's net profit actually declined 26%.
Oof, 26% down. While the others...
While peers like ICICI grew, and Axis's net interest margin, the core lending profitability, was 3.73%, noticeably lower than ICICI's 4.3%. That gap matters.
Okay, so competition is stiff, unsecured loans are a worry. Anything else? Any skeletons in the closet?
Well, there was that rather large one-time provision in Q2 FY26, remember? 1,231 crore.
Right, but wasn't that for some old loans? Not current problems.
Correct, for 2 discontinued crop loan variants, a legacy issue they had to clean up. But it does raise flags, doesn't it?
Yeah, it makes you wonder if there are other unknown unknowns lurking somewhere in their books from the past. Operational risk.
It's a fair question. So you have this tension, a potentially transformative opportunity, but you've got cleanup costs and these near-term risks.
So, weighing it all up, what's the forecast? What does the analysis suggest this means for future growth?
The projection is for a minimum profit after-tax compound annual growth rate, Pat Conchi, of around 13-15% over the next 5 years, so FY26 to FY31.
Driven by?
Driven primarily by leveraging that premium Citi customer base, the premiumization synergies, and achieving loan growth that's maybe 300 basis points, or 3%, faster than the overall banking system.
Okay, 13-15% in CGR is pretty decent growth. So, the final verdict. Buy, sell, hold.
It's nuanced. The analysis is clear. This is not a buy-and-forget stock, given the risks we've talked about.
Needs active monitoring, as you said.
Exactly. But it is framed as a potentially compelling high-conviction core holding if your horizon is long, say, 10 to 20 years.
Playing the long game on India's growth story.
Precisely. Playing the structural trends of premiumization and digitalization,
Yeah.
they often cite the credit card penetration rate, still only 5–6% in India, as this massive untapped opportunity. The whole thesis hinges on a market re-rating of the stock.
A re-rating, so valuing it more like its bigger peers over time.
Which brings us to the final provocative thought, I suppose. If Axis does manage to execute and deliver that 13–15% minimum growth over the next 5 years,
Yeah.
will we look back and see the current valuation gap compared to ICICI and HDFC as just a temporary investment opportunity that existed today? Or is it a sign of a fundamental structural disadvantage that persists?
Interesting question. Will the market reward the transformation or keep focusing on the gap? Something for investors to chew on.